We're going to be going over something called the firecracker effect. That is a term that Jim Dalton has coined. So to start off, the context of this day, something that's very important to remember is this is going to be July 3rd, and so this is going to be a half day, and July 4th being a holiday. So a couple things that we have in our favor here, but first the context. So we've got yesterday's value area right here, yesterday's range, and overnight inventory is net long, right? We're opening up outside of the prior day range. So you're going into this day with a long bias simply because we're opening outside of the prior day range. But you want to consider the fact that it is July 3rd and the odds of big money or the odds of a big move are probably lower. You never want to assume, but you just sort of go into the day with a little more skepticism, especially since it's a half day, right? So I'm going to hit play here. We're going to go pretty quick, but again, the context, we're opening outside of range. The firecracker effect, actually, just to give you a brief explanation, is whenever you have very mechanical buying and selling, where you can draw an obvious tight trend line, that's a sign of a short-term dominated type of activity. Buyers and sellers are trading as close as they can to that trend line. Those highs or lows are so tightly squeezed together that once you take one of them out, it's easy to trigger the second one, third one, and so on, right? So if I split these two up, we're going to look at yesterday and the overnight session. This is a pretty tight trend line right here, right? Pretty obvious. Let's see. It's pretty obvious trend line, right? And that's, again, a sign that we're being dominated by short-term traders. What do we know about short-term traders? They've got weak hands, and so the stop loss is likely to be triggered somewhere close to this trend line or just another obvious level, right? So we've got putting this back into this type of being able to view it like this. Again, we're going to hit play, and I'm just simply going to give you the kind of a rundown of the thought process as we go through this. All right, so from the open, moving up, 855. Let me separate this out. So we see it looks like we might have a decent breakout, but A period, not much range, and then in B period we came deep back down into A period, right? So the odds of a breakout at this point, an hour into the session, especially when you have a shorter day, are very, very low, right? And we take in consideration that tight trend line that we have here. We've got a lot of short-term traders yesterday and in the overnight session that are long, and they're also going to be off sides in a very big way if we start to move down. Okay, so that's essentially what the firecracker effect is. So we just get a lot of buildup, a lot of pressure being built right here, and then when the break happens, you basically have short-term traders from yesterday and then in the overnight session that are trying to lock in their profits, along with anybody that's trading today or anybody that's trading on the 3rd. Right? These are going to be the first ones to stop out of their loss. They're going to be the first ones to stop out, and then it's essentially going to trigger all these other stops. A story that Jim had told from his days trading in the pit was anytime that the large money or big money knew that the smaller money was very concentrated in an area, they would essentially switch from, in this case, buying to selling, and selling in a very large way, in a very big way, because they knew these short-term traders were going to be off sides, right? So again, let's just play real quick and we'll just take a look. So we have a poor low in CDEF period that's pretty close to the overnight high. And again, since this is net long, we know that if we do see a correction, most traders right here are going to be off sides, and so you can anticipate a lot of long liquidation as we move down. And then also we've got things like this prominent point of control, so you can at least expect price to get down to that level. So F period breaks that. You wouldn't want to short until, I mean, you can make the argument that you would put a position on after D period made this poor low right here and put your stop loss, somewhere up here. But if you wanted to take the more conservative trade, when we break that poor low is when you would want to enter. So right when F period broke that is when you would want to enter. And then you can see you're off to the races. That's the firecracker effect, essentially. You see this tight trend line up, and once that trend line was broken, you get a lot of long liquidation, people trying to stop out to prevent more losses, or people just simply trying to lock in more gains. I'll play this for just another second here. I mean, it just tanked, right? You had this little attempt to pull back, a little attempt to rally that just failed, and we just continued to move lower. That one's going to be a little tougher because value is developing higher prior to the previous day. So in that case, you want to be more aggressive with your trade management. But again, the context comes into play where a lot of these traders, or basically all of them, short-term traders, are going to be off sides. So at that point, it's almost like the developing value area being higher than the prior day is relevant. It's just less relevant given the context. So we keep moving down, You know the end of the story. So that is the firecracker effect.